Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through Twitter. It says Gareth Soloway is someone I highly respect. Your views on his latest video about a potential oil collapse based on the S&P crashing. So what I'm going to do is I'm going to give you my opinion and show you some data here on why I think oil may not, I mean, it may pull back, but we're not going to have a complete collapse like 2008 and 2009. His views on the S&P 500, I think, are completely correct. I would agree with them because we're coming into higher interest rates, and interest rates coming from a very low level that have been low for a very long time. A lot of money went into it and pushed those valuations quite high on the S&P 500. So if I were to zoom in here on the S&P 500, I'm almost there, guys, almost there. Here's the S&P 500. What's probably going to happen here is we're going to see a bounce in the S&P 500 back up to this breakout level, do a retest, and then head lower. This just takes time, guys. That's all. It takes time. And he's right. What we're seeing here is a ascending wedge. Let me get out of here. It's an ascending wedge. We came up to the corner here. Lots of selling pressure, a breakout. We'll get a return move, and then we're going to probably see this go lower, especially if they actually follow through with the rate increases. So I think he's right on the S&P 500. I think he's going to be right on the NASDAQ. The NASDAQ's going through that same ascending wedge pattern. It's going to come down, come back up, do a retest move probably, and head lower. Everyone knows the back test or retest move, and that's we're going to get that probably in the NASDAQ and S&P 500. Now, what he is saying is that oil is going to do a similar move to the S&P 500. And what I'm seeing here, I completely disagree with it. And the reason I disagree with it from a long-term perspective. So let me first say why I disagree and my time frames, because everything is based off of time frames. The S&P 500, if you were to look at those charts, let me do it one last time. Because going back and forth, you're going to see a major difference between the charts. The S&P 500 this is from a long-term perspective. I'll put a logarithmic. So I'm going to zoom out even more. What this is you have expansion phases of real estate in these areas. And the S&P 500 tracks sideways during those periods. So you'll see like a topping pattern, it'll pull back, and it'll move sideways for about a decade. These are the expansion phases of those periods. And we're coming into an expansionary phase, and we're coming into a ascending wedge, which is broken to the downside. We'll get a return move, and then we'll probably head lower. And in an area where the market will do something like this, and then it'll eventually break to the upside. And I don't have this drawn to scale. It's not right, but it's probably going to do something like a consolidation pattern like this and an eventual break to the upside. But on oil, I'm going to go back to oil here. So we're getting oil here. This is crude futures on oil, and why I disagree with them is we have a massive descending wedge pattern that we're breaking to the upside. So he's right that the S&P 500 and that the NASDAQ is going to collapse. I agree with that. He's wrong that crude oil would follow the collapse completely like it did in 2008. And what we have here is a break to the upside. We've got a nice, good-sized move here going upward in a megaphone pattern, which will probably break to the upside and eventually resolve itself upward at some point. I don't want to get caught up in the short-term moves. I don't want, this could pull back again and go back to $70 or $60 or something like that, somewhere on the bottom here, maybe $67, and still be in a massive uptrend move. But what he's missing and what he's not accounting for in his analysis, in my opinion, is the housing starts. And the housing starts is what caused that crash in 2008. The '08 crash was the housing market crashing. And the money that gets loaned into the system against those new homes crashed quite dramatically. And this here is the commodity bull market there. Actually, what I should write or do is it went from like 98 was our buy point, and our sell point happened in '08, where this was coming down. And whenever you go below this, you got to start exiting your stocks. So this is the commodity bull market there. Notice that the housing starts was going down in that time frame. That's your leading indicator of the crash. So that was the '08 scenario, and the destruction of credit and the loaning destruction and foreclosures and short sales that happened in that crisis in housing. What is happening now is that we have a housing shortage, and we're going into an expansionary phase coming up. So what I am proposing is we are similar to this phrase here, where if we were to look at the housing starts across, that interest rates go up in the 2000 to 2001 dot-com bubble, and that the S&P 500 and the NASDAQ pulled back from 2000, 2001 top, and that the same type of scenario is going to happen now, because we're going into an expansionary phase, which kicks up the interest rates. It kicks up inflation, and inflation is going to increase interest rates. So that increasing of interest rate going up is going to drag down the stock market and the NASDAQ. In a beginning of a expansionary phase of real estate, which means that we're going to build a lot more new homes, the inventories are drawn down, and they're very low inventories. With the low inventory and with the shortage in the housing market isn't in a interest rate sensitive spot in its cycle. So they're not. It's not as sensitive in this type of environment to interest rates. So we're going to continue to go higher on the housing starts, which is going to continue to be inflationary because of the market supply demand imbalance in real estate. So I don't think that oil is going to go down, because it's going to have support from the housing market and the inflation entering the system. Now, could it pull back in the short term and grab, kind of come back with the overall markets? Yeah, that very well could happen. But I don't think it's going to be a blowout crash, and I don't think it's going to remain low for a very long period of time. Something like a 2009, 2010, 2011, like that type. It's going to continue to go on up, I think. But it may be sticky a little bit in the beginning. It might pull it back a little bit, and then boom, it's off to the races again. That's kind of my viewpoint. Just like uranium's happening. Uranium, we have a pullback, and I think we're going to eventually head on higher. I don't think we're going to pull back and stay down like most recovery phases of real estate. When this expansion phase gets moving, we showed that permits last time. We built 1.7 million, which is a good expansionary phase. We had over 1.8 million in the permits. So I would suspect that the housing starts will continue to move higher based off of the permits. And I know not all permits get turned into housing starts, but it's usually a good indicator, and that's the only indicator we have, that we have a stronger housing market with the permits going up. So I think that the housing market's going to remain resilient. I think that stocks are going to go down, and I think that oil is going to remain pretty robust and continue to its path higher. So I disagree with his analysis. I agree with my analysis. Obviously, that's pretty obvious. And I think oil, in the very short term, yes, it could go down a little bit, but I don't think it's going to remain down if it does. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.